Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our July 2014 webcast, another step closer to finalizing IFRS 4 Phase 2. More education on participating contracts while IFRS 9 is issued in final text. This is the title that I've chosen for today's webcast, where we're going to look at a number of things that have taken place during the course of July. As always, our agenda is structured around three items. First of all, I'll give you the highlights of the decisions from the ISB meeting this month. Then I will look into those decisions and the recommendations that led to those decisions in a bit more detail. That will be the substantial amount of time dedicated in the webcast. And then finally, I will talk about the next steps and give you an update on the timetable. It is during the previous agenda item that I will cover also the publication of IFRS 9 this month. The highlights for July are, first of all, the meeting was held on the 22nd of July. There was, first of all, an educational session where directional decisions, which are just indications the ISB gives to their staff as to how they should develop a paper for a decision-making session. And again, the subject was, unsurprisingly, participating contracts. All focused around the presentation of interest expense in the event that the OCI solution applies to a portfolio of participating contracts, with two key areas. One is the directional decision the ISB has given to the staff that they would like to debate two new methods for presentation of interest expense and their application to different types of cash flows. And in particular, that one of these two methods would be an effective interest rate method, taken from IFRS 9 as a possible method for P&L presentation. The educational session was followed by two decision-making sessions. The first one on contracts without participating features and the locked-in rates that will remain a requirement to be used for accretion of interest on the CSM and to calculate the present value of cash flows that unlock the CSM. The other area, again resulting in no change, is that the OCI solution accounting policy introduced in the March decision of the ISB will not be introduced with additional guidance, so nothing more will be written in either the new IFRS on insurance contracts or IS8 in terms of how the change in accounting policy will be done. And equally, the requirement in IS8 for any voluntary change to be retrospectively applied will be retained, with the usual caveat from IS8 that that restatement can be avoided only in the event that is impracticable. Finally, IFRS 9 has been published. The financial instrument standard has been completed and it is now ready for application with mandatory effective date 1st of January 2018. So let's now dive into the educational session on participating contracts. The first part of this discussion was around the approach for determining the interest expense when the OCI solution is adopted. So the board, as they've done in the meetings in June and May, have taken a view that certain assumptions, certain working assumptions will be accepted in discussing these papers. And this one assumes that the OCI solution will be adopted for participating contracts, an assumption that I personally believe is quite plausible. The ISB discussed then a method other than the book yield approach, which was discussed in June, on how to present into the profit or loss the interest expense from the unwinding of the time value of money. And the staff proposed an approach that had some characteristics of particular interest. The first one being that they would introduce a test whereby if the cash flows of a contract is substantially comprising cash flows that are affected by the value of the underlying items, and that is true over the lifetime of the contract, then there is only one discount rate that will have to be calculated in order to determine the interest expense that will be presented in the profit or loss. The second point is that any new method to be considered alongside the book yield approach in the decision-making session would need to be reset whenever the insurer believes that there are changes in the estimates of the amounts to be paid to policyholders. And finally, that the discount rate used for the presentation of interest expense in profit or loss should be determined using an approach similar to the effective interest rate method for floating rate financial instruments, as well as the book yield approach and the reset rate that the exposure draft published in 2013 under paragraph 60H. The analysis of the staff focused on the first proposal and the need to split the cash flows of our participating contracts between those that are asset-dependent cash flows from those that are either fixed or non-asset dependent. Under the 2013 exposure draft, the interest expense would be required to be determined using the locked-in discount rate for the latter group of cash flows and a reset locked-in rate for the former group of cash flows. The reset rate is the one that I was referring to just a moment ago, was described in paragraph 60H of the exposure draft, whereby for insurance contracts where the cash flows are asset dependent, but the insurer is not required to hold the underlying items, the standard would have required the interest expense to be determined for those asset dependent cash flows by using a locked-in discount rate, which is reset every time the insurer believes that there is a change in the expected cash flows payable to their policyholders. A situation that in our own analysis at Deloitte we believe is occurring at least annually for those contracts. So that makes it an annual reset at least. That method of presenting the P&L expense is retained and is actually the second of the three methods we're going to talk about today, the first one being the book yield approach, and the third one being the effective interest rate from IFRS 9. But the difference now is that because of the complexity and the cost associated with applying one of these three possible methods to only the asset-dependent cash flows, the proposal that the ISB staff would like to discuss in the decision-making meeting in September is whether this approach, one of these three approaches, whatever is selected at the end, is applied for all cash flows if certain conditions are met. And these conditions are that substantially all of the cash flows in the contract are asset dependent, and that asset dependency persists throughout the life of the contract. That will eliminate the complexity and cost from the original proposal in 2013, although the staff acknowledged that from a conceptual perspective, that was perhaps the most appropriate basis for calculating. This is also an approach that would apply, in our opinion, that is an interpretation from Deloitte, to all the other contracts where such a substantial prevalence of asset-dependent cash flows is not met. What we believe is going to be the case is that in those cash flows, the one rate only approach will still remain, but it will be the locked-in discount rate that determines then the P&L unwinding rate. So to recap, in our understanding, this decision could mean that out of one of these three possible methods, there will be a rate which will apply to all types of cash flows if those cash flows are asset dependent, or if the majority of the cash flows are not asset dependent, the locked-in discount rate will remain in place in order to present the interest expense in profit or loss. When the paper then analyzed how the reset methods could work, there was an explanation that the 2013 exposure draft method in 60H would remain in place and would essentially determine the yield curve that this insurer would apply under that particular methodology to all its cash flows. An alternative approach to this methodology would be the use of the effective interest rate method from IFRS 9. There is an acknowledgement in the paper from the staff that the yield curve, the one that was proposed in 60H, was a simpler approach to this one. However, the staff analysis would indicate that the effective interest rate, in their opinion, could reduce further the accounting mismatch that may exist between the insurance liabilities and the assets backing that liability, which may be the underlying items in a participating contract, because those assets, those underlying items, when they are debt instruments, which the staff believe is mostly the case in a number of funds, would actually be accounted for using the same effective interest rate approach under IFRS 9. As you remember, IFRS 9 will require an amortized cost presentation of returns from debt instruments that are accounted for under the fair value through OCI as well as the amortized cost basis. The discussion following this analysis was quite lively. There was generally a support for developing an approach based on the effective interest rate method. So that was an interesting observation we felt that we wanted to share with you, giving to this third method that has just emerged this month for the first time a higher chance of being adopted in the final standard than we would have thought in the last few webcasts as we reported back on the educational sessions on this topic. The other salient points from the discussions were that these two new approaches, well, new to some extent, they are both derived from an existing literature, the Exposure Data 2013 for the reset yield curve and IFRS 9 as far as the effective interest rate is concerned, will need to be analyzed from a comparative perspective in the final paper that will be tabled for decision in September, probably. And also, there should be a comparative analysis against the book yield approach, so that the board can be working towards the selection of one method only. That's the objective. One method only will be selected out of these possible three. There is also a point that was made during the discussion as to whether or not there was a need for a bright line for the substantial proportion of cash flows dependent on underlying items to enhance the comparability of this new regime being applied in practice. Another point which we thought was important is that these debates stimulated the question from a number of board members as to why not considering the effective interest rate as a method that should apply for all types of insurance contracts, both participating and non-participating, when the OCI solution is used to present in profit or loss the cost of the time value of money. The staff agreed that that was an interesting thought, but also recommended that the ISB allows them to finish their work on the participating contracts requirements first before testing these as well as all the other potential change that the decision-making sessions in September, October may bring us on the other side of the universe of insurance contracts, the one that is non-participating in nature. So when they heard all this, the directional decision that the ISB took was to agree that these proposals were valid and they deserved to be discussed together with the book yield approach. So in September or October, which are the two sessions earmarked for the finalization of this topic, we will see a paper that presents the merits of book yield approach, locked-in reset rate or yield curve, and the effective interest rate method, and the board will choose one of these three. We also believe that, having seen the comments during the discussion, it is plausible that this application of the selected method to all types of cash flows subject to this substantial proportion test will be adopted by the ISB. Obviously, at this stage, it's just a Deloitte assessment of the likely outcome and not one that comes from a tentative decision officially recorded by the ISB. Moving then to the decision-making sessions, let's start with the CSM accretion rate and rate that is also used for the calculation of the adjustments to the CSM as a result of new expected cash flows being recognized on the balance sheet for future coverage and future services. The issue is whether the current rates used for the measurement of the balance sheet liability at the reporting date should be used for these two accounting requirements, or, as proposed in the 2013 exposure draft, the locked-in rate that was used at initial recognition. The analysis of the staff indicates that their basis was remaining valid as far as they were concerned, and that was the objective of separating clearly within the financial statements the margin that comes from underwriting and the margin that comes from investment performance, being the difference from the return generated by the assets backing the insurance liabilities and the unwinding of the discount. They also acknowledge that despite believing that this logic was still valid, a number of commentators to the exposure draft suggest that current rate should be used to be consistent with all the other components of the insurance contract measurement. And Deloitte was one commentator that actually made that point. The locked-in rate, however, in the staff analysis, is the conceptually correct answer if that split between underwriting and investment results should be preserved. There was also an observation that some letters, not the one from Deloitte, but some letters proposed that an accounting policy choice is given. And this proposal is clearly now more attractive from a discussion perspective because of the recent decision to amend the OCI solution from being a mandatory treatment to one that is now subject to an accounting policy election. And therefore, the parallel could be drawn between that election and the accounting requirements on accretion of interest to the CSM. The staff analysis then continued and analyzed also the impact of the discount rate choice on the calculation of the unlocking adjustments to the CSM. And the ISB was reminded by its staff that the 2013 proposal suggested that the CSM should be adjusted for these changes in future present value of cash flows if they relate to future coverage and future services, that the effect of the changes arising from the discount rate should not be offset against the CSM, and therefore the present value of cash flows that unlock the CSM should be calculated using the rate at inception only. These effects of the discount rates should be presented in OCI as required in the 2013 exposure draft by the mandatory OCI solution. Now that mandatory nature has been removed, and so the fact that some respondents indicated that there was a benefit from using a current discount rate were considered in the analysis. And in particular, the fact that the use of the OCI solution becoming non-mandatory could lead to a number of insurers to decide not to use the OCI solution whatsoever in their financial statements, still leaving them with the potential requirements and cost of recording and storing information about locked-in discount rates for these accounting requirements on the CSM. So that cost may not appear to be justified in those particular instances. Second is that any locked-in information would make the reflection in financial statements of the economic cost of the particular dimension not in line with its current value. So if you then take these considerations forward, you can appreciate that the unlocking of the CSM with the current rate would not allow the neat separation of underwriting and investment results, and therefore one of the core benefits in the analysis of the staff that the new model would bring could be lost or diluted. In particular, if current rates would be used to unlock the CSM, you would then have portions of the changes in discount rates being reported as part of the underwriting results, and vice versa, changes that would have been reported in the investment margin will not feature in that subtotal. The other thing is that the calculation of the OCI reserve in the balance sheet would be far more difficult to explain and calculate. So the staff was, if you like, fairly analyzing pros and cons across the various possible dimensions in order to analyze what best recommendation they could put forward. And their conclusion was that the use of a current rate was far less beneficial than the retention of the 2013 exposure draft proposal to use a locked-in discount rate in all cases. The board members commented extensively on this. In fact, it was probably another lively discussion, because they appreciated that there is an issue that affects measurement of the balance sheet here through the different calculation of the CSM balance at the end of a particular period, the moment in which you allow the use of a current rate. And so that was clearly an important factor that a number of our members wanted to put on the table for consideration when the chairman was going to call for a vote. The second point that we observe is that if an insurer does not use the OCI solution, it was acknowledged that there will be a desire to present the full effect from the time value of money on a current basis in profit or loss. Another point was that if an accounting policy choice was made for accounting for entities that use the current rate, you would then accept that CSMs for identical products, identical contracts, would be measured on a different basis depending on that accounting policy choice. And several board members expressed their view that this would be far from being a recommendable direction for the new IFRS. Finally, we noted that the board acknowledged and understood that this was not about cash flows, but it was really all about the allocation of the originally discounted CSM to future periods as the service is provided. And if we refresh our memory, the CSM is indeed the discounted value of a series of undiscounted future profits as they emerge from the difference of undiscounted inflows and outflows over the life of the contract. And once those undiscounted profits are brought back to the initial recognition, they are carrying in themselves the effect of time value of money, which must be reversed over time in order to release in the appropriate period the undiscounted profits that should be released at that point in time. Now, clearly, the ISB has abandoned the locked-in release proposal that was part of the 2010 exposure draft and has introduced the unlocking adjustment. But in order to preserve the unlocking from any impact of interest rate fluctuations, the only way they felt comfortable to go is the use of the locked-in rate. And the redeliberation of that matter, as you can see from the vote in the last bullet of the slide, led them to the same conclusion this time around. 10 board members were in favor, still a relatively large minority, but not enough to sway the vote to a reconsideration. Often, if the majority is really narrow, the chairman takes the view that further discussion is warranted. In this case, we believe that the tentative decision will be retained, as you can see on the slide, and only the reassessment after the completion of the participating contracts could lead to some amendments to this decision. The next topic for tentative decision was a follow-up from the March decision to introduce an accounting policy option on the use of the OCI solution for the presentation of the time value of money in profit or loss. And the issue was really whether further guidance was necessary, as well as whether the retrospective restatement of comparative figures would always need to be a requirement of the standard, as it is for any voluntary change of accounting policies under IAS 8. The recommendation from the staff, and I want to put it right away to your attention, is not to change the requirements in IAS 8 and to avoid the introduction of any additional guidance for this particular change in accounting policies. The reason for that is summarized on this slide. These requirement that will be this option that will be introduced in the final IFRS to elect on a portfolio by portfolio basis whether an accounting policy choice should be made to use or stop using the OCI solution needs to meet the requirements of IS8, which are, in the analysis of the staff, fairly rigorous and demanding. The IS8 requires that any change in accounting policy must make the financial statements more relevant and more reliable than they were before. So that set of criteria is quite demanding, and it should be in itself a sufficient obstacle to avoid a frequent change of accounting policies, which may have justified additional criteria, additional guidance. Also, the comparability that is enhanced by the retrospective application and disclosure of the effect of the change in accounting policies on prior year numbers is something that the staff analysis indicates would be extremely beneficial to preserve in the new regime. The restriction of changes in accounting policies as a result of the criteria discussed earlier, as well as the cost of restating comparative, should altogether represent a sufficient barrier to make these changes in accounting policy really something that the insurance companies would consider implementing after careful examination. And that is effectively what the ISB wishes to achieve by introducing this regime on the OCI solution. And so when the members discussed this point, there was very little concern about the recommendation not to introduce additional guidance. But the entire debate, almost the entire debate, was focused on the issue of retrospective restatement, in particular because one board member very strongly expressed his belief that given that the change in accounting policy is very likely going to be triggered by the reclassification requirements in IFRS 9 as a result of a change in a business model, which is applied prospectively in IFRS 9, he felt that a symmetrical application of the accounting policy option for the OCI solution would have been only appropriate. And so he suggests that although no guidance should be introduced in IS8, but at least the requirement of mandatory restatement should be adapted to the circumstances, and in particular if the accounting policy is introduced as a result of a reclassification caused by a business model change in IFRS 9, that restatement should not be required. Only one board member was persuaded by that argumentation, and when the chairman called for a vote, 2 members were absent, so they did not vote, but 10 members supported the staff recommendation, and only 2 present were against it. So that's another one with a fairly large majority that is going to be added to the list of tentative decisions leading us to the completion of this project in the coming months. Let me now just spend a few minutes to talk about the publication of the final text of IFRS 9. This publication concludes a 5-year journey that the ISB started to reform substantially the accounting for financial instruments, which has brought now together the 3 phases of the original project: classification and measurement, impairment, and edge accounting. In terms of the content, a very, very high level run through of these 3 areas. From a classification and measurement perspective, we move away from a regime which was full of options and designations to one that actually is anchored around testing against the business model that an insurance company may have for managing financial assets and the characteristics of the cash flows of those financial assets. Subject to meeting those criteria, there is an automatic allocation of these assets into 1 or 3 possible categories: amortized cost, fair value through OCI, and fair value through profit and loss. The only designation remaining is at initial recognition of financial assets. The insurer could designate those assets to be accounted for at fair value through profit and loss and take them out from the other 2 categories. But that's the only direction in which the designation could be done, a fair value option, subject to 2 criteria. One is that you are significantly reducing or eliminating accounting mismatches, or that you are managing those assets with reference to their fair value rather than their amortized cost. Accounting for financial liabilities remain essentially unchanged from the IAS 39 model, with the only exception of the treatment of own credit changes, which is now required to be recognized in OCI, unless that fair value option that I mentioned earlier also applies to those financial liabilities. In terms of impairment, probably the biggest change from IFRS 9, we have now a new impairment model that moves away from the incurred loss model, so heavily criticized during the recent financial crisis due to the time lag that resulted in credit losses emerging through earnings of financial institutions only at a later stage, to an expected credit loss model, whereby even events that have yet to occur, but that could potentially occur and affect the recoverability of cash flows from financial assets, will have to trigger the recognition of an impairment loss in the earnings of an insurance company. Obviously, this applies only to amortized cost and fair value through OCI assets. Fair value through profit and loss do not have the onerous impairment testing applicable to them. There is also a new hedge accounting set of requirements that by many commentators is going to produce a better reflection of the entity risk management activities, and one that we at Deloitte have encouraged insurance companies to consider more carefully, given it is now less severe in terms of its effectiveness testing, and it may result in a number of asset liability management practices being available for hedge accounting if that treatment in the financial statements is advantageous. As I mentioned at the start during the highlights, the standard is now going to be effective on a mandatory basis on the 1st of January 2018, but obviously subject to local endorsement requirements where applicable. Early application is permitted. There is one interesting point from a transitional provision perspective that I wanted to mention, and that is that you can only adopt the whole standard, but if you want to, you can adopt one requirement only earlier and leaving the rest for later application. That is the requirement to account for the own credit risk changes in OCI. That is the only one that can be applied at any time in isolation. The rest will have to be brought into the financial statements at the same time as a change in accounting policies as a result of a new standard being adopted. Deloitte has already planned to release a number of things that I want to bring to your attention. There's going to be a few interviews led by our financial correspondent, Robert Bruce, plus we will be releasing a number of industry insights, including one dedicated to the insurance industry, and IFRS in Focus has just been released as we speak. Let's now move on to the third and final item of our agenda for today's webcast, the next steps. The remaining issues are actually shrinking quite considerably. We only have now the long process around the participating contracts going to be completed. Officially, we believe the educational sessions are now done, so we should look at the September-October meetings as the key moments for deciding what to do on participating contracts. Other than that, there are only a few minor follow-up issues related to the OCI decision taken in March, plus the reassessment of the premium allocation approach because of the recent decisions on non-participating contracts accounting requirements. The IASB continues to plan for all of its discussions to be concluded around September-October for participating contracts. So there will be a major milestone to be achieved, and Deloitte will watch closely how that process evolves. And then after that, only transitional requirements will remain to be discussed with the first-time adoption approach that insurance companies will have to use, as well as the choice of the mandatory effective date. Now, let me talk about the last bullet first before I give you my view as to when this date could be. And that is because the publication of the standard in the first half of 2015 would trigger the commitment the IASB has given us to set the effective date to a period that is approximately 3 years after the publication of the standard. Now, if we are looking at the transitional requirements following immediately after the participating contracts decision, it is reasonable to expect that the decision-making process for the whole standard will be complete by Christmas. That means that you can then calculate the balloting period that normally follows the last meeting of a deliberation process, and we have used the precedent of the 2013 exposure draft when 4 months lapsed between the last decision-making meeting in February and the publication of the standard in June. And that was, by all accounts, looking back at previous performance, a fairly long balloting process, because you may remember at the time the IASB was busy with all of the 4 major projects: insurance, financial instruments, revenue, and leasing. Now, revenue is done, financial instruments is done. There is still macro hedging discussion, but we are in the stage of a discussion paper, so it's still far from being a pressure point from a board activity perspective. Leasing is probably at the moment a little bit behind insurance in terms of how much it has been progressed. It is reasonable, therefore, to expect that another 4-month period will be really the longest that we can anticipate the balloting process would take. So 4 months, let's say, to be conservative, will take us to then April 2015 as the possible date for publication. And that will still represent, in my opinion, an approximate period of 3 years if the mandatory effective date is chosen on the 1st of January 2018. That date will have also the benefit of being fully aligned with the IFRS 9 effective date, which is a major feature in terms of what the constituents have been telling the IASB last year after responding to the exposure draft. That is certainly attractive for a number of board members to retain in the final text of the standard, but we will see. As the project resumes after the holiday break, Deloitte will continue to observe it for you, and through our publications and webcast will keep you updated. And that takes me really to the last slide before opening the floor for Q&A, to remind you where you can find all these updates. That's the website page, www.deloitte.com/I2II. Let's close the recording now and open the floor for any questions.